Now we're getting to the good stuff. Let's talk about the four financial statements that companies are required to prepare. The first one to be prepared is the income statement. The income statement lists the company's revenues and the company's expenses. So what does the income statement tell us? It tells us if the company was profitable or not. This statement shows the company's net income by listing the total revenues, then subtracting the total expenses that the company incurred during the accounting period. If the result is positive, then the company made a profit. This is called the net profit. If the result is negative, however, the company has suffered a net loss over the period of time covered by the income statement. If you're looking to invest in a company, then the income statement is typically the first place that you'll look. Before digging any deeper, you're going to want to check to see if their operation is at least turning a profit. Just a quick side note, in the recent past, the income statement was frequently referred to as the P&L, the profit and loss, so you'll encounter that name as well for the income statement in your studies. Next, we have the statement of owner's equity. It's the second financial statement to be prepared. Once again, the statement tracks a change over a period of time. In this case, it tracks the changes in owner's equity, or how much the business owes to its owners. First, at the top of the statement, the first line item, we see the starting balance of the owner's equity at the beginning of or going into the accounting period. Then on the next line, any new investments added by the owners are added in. Next, any withdrawals by the owners during the accounting period are subtracted. After that, we look back to the income statement to see how much profit or loss the company adds through its net income during this accounting period. Finally, on the last line of the statement, we arrive at a new total owner's equity for the end of the accounting period. The third statement is the balance sheet. The balance sheet shows the company's financial position at a specific point in time. On the balance sheet, you'll find a list of all of the accounts that a company keeps track of. These accounts are grouped into categories as follows. First, we see all of the company's assets, everything that they own, cash, payments owed by customers, real estate, inventory, equipment, supplies. It's all listed here. Next is a list of the company's liabilities. This includes debts to the creditors and customers, salaries and wages owed to the staff, taxes owed to the government, and so on. Finally, the balance sheet lists the accounts that are categorized as owner's equity. These are the accounts we just saw listed in the statement of owner's equity, including the owner's investments or shares in the company, the owner's withdrawals called dividends from the company, plus a new one called the retained earnings. You can think of retained earnings as the accumulated income from this and previous accounting periods that are being held for future use. Then finally, the fourth financial statement a company prepares is the statement of cash flows. This indicates how much cash comes into the company, how much it has on hand to work with, and what the company spends its cash on. Put another way, the cash flow statement shows how money enters and exits the business during an accounting period. This particular statement is not covered on the midterm in any more detail than I've described here, so we'll come back to it in the final videos of this course. So we have one financial statement, the balance sheet, that captures something at a specific point in time, and then the other three statements capture something over a period of time. We're going to focus during these midterm prep videos on the first three. Let's get started.